So now we are going to move into our next section and look at the economic environment and outlook. And I'm going to hand it over to Mike McLaughlin.
Hi there. Thanks, Leslie. It's Mike McLaughlin from Morgan Stanley. I'll take maybe 10 minutes to discuss the state of the tech industry as it relates to the demand for tech products out there as we see it in our role as capital providers and strategic advisors to tech companies around the globe, as well as the implications of that end demand for capital markets and strategic activity that is mergers and acquisitions, which is relevant to a lot of folks on the line, I presume. To come to a point of view on all those things, you really have to start with a pretty high altitude view. Back in the good old days before the Great Recession, everyone assumed that the economy was rolling along just fine and tech was its own little world that was driven by factors that were independent, at least to a significant degree, of what was going on in the global macroeconomy. Clearly, starting in 2008, that changed, and the way that investors and business owners in tech have had to think about the world of tech since then has been much more in terms of what's going on in the global economy and the world around me, and then let's think about how does that impact tech. That's the page you see on your screen here is my assessment of where we are today with that high-level question, what is the state of the world economically, and how confident can we be about the view of the future, and then let's talk about how that implicates tech. So this slide is called the new normal. 3 or 4 months ago when I would do a talk like this slide was the bull and the bear case, because there was still a pretty clear debate between those who believed the economic recovery was real and those who believed that there was we were on a trajectory to double dip. There were those who believed that capital markets were still at risk, and so forth. Now it really is a consensus that has emerged amongst at least financial players that this is pretty much what the world is likely to look like for the next 4 to 8 quarters, and that there are some debates around that, but the consensus is pretty broad and strong, as indicated under the green column. Excuse me. With respect to the global macroeconomy, the policy actions that have been taken by the sovereign governments and the central banks have largely worked in averting the crisis and stimulating a modest but pretty robust global recovery that is generally expected to continue on more or less this trajectory for the next several quarters. And there is very little fear out there anymore of a double dip economically, certainly on a global basis, while there may be some sub-markets that have some risk. The U.S. and the developed markets and the major developing markets feel pretty good. The debate around the macroeconomy is frankly somewhat longer term. There's the potential impact of what's happened, the tragic events in Japan, because the size of that economy on a global basis and the importance of that, frankly, for technology, it could have a meaningful impact, but no one really thinks that's going to derail us. In the U.S., should some of the extreme budget tightening measures come to pass, that could significantly reduce domestic growth, at least in the short term. And then there's other issues around the sovereign debt crisis and so forth. But I think that this consensus is that the global economy is on that robust and relatively sustained path for the medium term. And then working down the page, inflation had been a hot topic of debate certainly throughout 2010. Again, there is increased consensus that is under control. Expectations for inflation looking out for the next 5 or 10 years, frankly, in terms of market implied rates, are very benign, and there's a lot of faith in the Fed and the ECB that they will be watchful of monetary policy and not let inflation in a alarming way develop. The dollar is settling down and trading a little bit more like currencies are supposed to trade, that is on the fundamentals as opposed to fear. But events like Libya and the Japanese earthquake and tsunami cause distortions, but again, with respect to the dollar, that feels like it's returning back to normalcy in terms of the way currency flows and valuations typically work or are supposed to work. The implications for credit and equity markets are all good, that the credit markets have been open to pretty much all categories of borrowers, that is credit quality of borrowers, for the last 9 months. And spreads and risk appetite continue to look better and better every day, but for short periods of setbacks because of some global events. And equity markets are very open, and there's lots of capital raising going on at relatively attractive valuations. And importantly, investors are no longer swinging the markets open and closed based upon the latest headlines of geopolitical events. That has all of the above has direct relationship on the M&A market, that capital access, confidence in the future, stabilizing valuations are the perfect recipe for an active M&A market. We'll talk a little bit more about that. So if I can get the next slide. And this is just a summary of our key economic forecasts, and then we'll get into tech. And as you can see at the top of the page, we currently see 3.3% growth in the U.S. and 3.5% in the U.S. in 2012, with global growth being a little larger than that because of emerging market contribution. But again, it feels to us like it is sustainable and certainly lasts through the end of 2012 with low interest rates through the end of this year and benign inflation, which is a great backdrop for companies and consumers to buy tech products and drive the tech ecosystem, which we'll talk about on the next page if I could get that slide. This is a survey that Morgan Stanley's research department does 3 times a year. It's of 200 CIOs in medium-sized and large enterprises around the globe in a variety of different industries, judging their subjective expectations about where they're going to spend their money and how they feel about their IT environment. It's a very robust survey with a lot of longitudinal consistency to it. We've been asking the same questions for a long time, and we get a lot of respondents, so it's not just a very small sample set. So you can learn a lot from what comes out of this survey. The most recent one was done in January, and you can see in the top left-hand part of the page, we've compared what the 2011 IT spending expectations were from those 200 CIOs in October of last year and what they were in January. And you can see that in every case except for software, expectations for spending are A, pretty good in terms of the amount of growth, and B, they're going up. So optimism is increasing. And then if you look across the rest of the page within software, hardware, and comms equipment, 3 major categories of spending, IT services being the other one that's not on the page, you can see that there are, there's a pretty good diversity of where that spending is going to go, and it's spending on things that I would characterize as increasingly optional kinds of spending. So if you look at CRM and ERP, for example, in software, that's mission critical. You got to have it. If you don't have if your ERP system is not cutting it, you just got to spend. But if your spend management system or your HR system, you can defer those kind of expenditures. And I think it's encouraging that we're seeing CIOs say that they are going to increase spending in some of those more discretionary areas. And this page doesn't speak at all, by the way, to some of the consumer-driven parts of tech, like, or most of the consumer-driven parts of tech, like mobility, like social networking, and as you can see from the world around you, whether it's iPads or Facebook, that ecosystem is also very robust and feels very good. Next slide, please. So let's drill that down into what that means for the markets, and then we'll talk about M&A. In terms of capital issuance, particularly equity issuance, which is the lifeblood of growth in technology, that is, small companies need to have access to equity capital in an efficient manner in order to fund the high growth that is the domain of tech. having an open equity market is very important, and the volatility of the market is a key predictor of how accessible the equity markets are going to be. And you can see on the top of the page we plotted the VIX, which is a volatility index that's widely used. You can see how it has had some ups and downs and had a little bit of spike during the European debt crisis in May of last year. We had a spike around the tsunami in Libya in March, but it's now back down into that green zone of the VIX of less than 20. And you can see at the bottom of the page how the equity volumes have generally correlated with the been inversely correlated with volatility. And it's across categories. It's not just IPOs; it's also follow-ons and convertibles, leading to great capital access for companies, which gives them the ability to grow, which is all good. Next slide, please. Sorry, this page is focused on the IPO market specifically, and if there is one bellwether for the health of technology, it is the IPO market. A robust and healthy IPO market means there is positive sentiment in general about technology, there's risk appetite among technology investors, and there's also good company creation that is creating a supply of IPO candidates. And we have seen pretty much since the second quarter of 2010, maybe even put it into the late first quarter of 2010, we've seen the IPO market come roaring back for technology, and you can see from the statistics. There was a little bit of a blip in the summertime and fall of last year where some lower quality companies came to market, and the pricing outcomes were not all that great. But that has been corrected, and the performance of IPOs and the quantity of IPOs has been excellent over the last few quarters, and you can see that the backlog is also at 30 tech deals on file, is also very healthy and near sort of historic, not historic highs necessarily. It was higher in 2007. It was close to 45, but it's still very healthy and indicates both good company formation and good capital access for those companies. Next slide, please. And then let's just end on M&A. You combine a good macro environment with positive expectations about technology and market demand. You put that together with lots of capital access and risk appetite, as well as a relatively confident view of a stable future, and it's a perfect storm for a good M&A market. And we have seen lots of deals. I mean, just in the last week, Morgan Stanley was involved with Texas Instruments buying National Semiconductor, with eBay buying GSI Commerce, with Parametric this morning advising buying MKS, a Canadian software company. There's all kinds of dialogues going on, and the strategic environment is very robust. And it's a combination of all of these factors on the page, and they're different by sector, exactly what's driving it, and we don't really have the time to go into that. But suffice it to say that if you are a buyer, you are well funded and you have relatively high appetite, and if you are a seller, you are in a pretty good position. Next slide, please. This is I'll just one more slide after this one. This highlights one of the dynamics that is having an impact that is driving both large and small acquisitions, and it's just the amount of capital, the cash capital that is accumulated on technology company balance sheets through the recession as capital was conserved and costs were cut. Of these top 10 companies that are active buyers, there's $267 billion of cash available, and another 100 plus a year of cash flow generated. That's a lot of money to put to work, and is a very important driver here. And then I'll turn to the last slide, please. And then finally, this is just volumes in the M&A market in tech, and you can see that all that has added up to strong activity. We just finished out the first quarter with $41 billion of tech deals, which is the highest volume we've had since 2007, and we think that that's more or less sustainable for the rest of the year. So I'll stop there, and if there are questions at the end, I'd be happy to